Yes, it's billed as a U.S. economic presentation, but I apologize. I'm going to talk about a couple more countries first and then go to the United States, because you might have noticed that what happens in Athens, Greece, seems to affect our stock market more than what happens in Chicago or New York. So we have to have a world context. And I'm going to kind of fast forward through some of the slides and linger on some of my favorite charts to talk a little longer about. But we'll kind of start at 10,000 feet, and then we'll get ourselves into the current economic outlook and what the Fed's thinking about and where things are. Our lawyers are present. I don't give investment advice, even though you might think so. It's really not. Don't take it. Central banks, I really want to focus on central banks right now. And central banks have objectives and they have tools. And if they have more objectives than they have tools, it usually gets them in trouble, and they have to balance things out. If any of you are mathematicians, generally if we have a system of equations with 5 unknowns, we need 5 equations, or we can't solve it. It's the same thing with central banks. If you give central banks 2 things to do, but only 1 thing they can change, like interest rates, then they're in trouble and they have to do trade-offs. But the real problem is that they have one really big unstated objective in addition to all their stated ones. Typically, the financial system stability is their most important objective, and yet it's often not even in their charters. It is in the Federal Reserve Charter, but it's not in more recent legislation about the Fed. When the U.S. Federal Reserve was chartered in 1913, the charter reads, and it's actually inscribed on the halls of the New York Fed, to maintain an elastic currency. So I asked everybody that was 90 years old, what's an elastic currency? What did it mean back in 1913? And the answer, actually it came back pretty good. It meant that you were supposed to have a flexible enough banking system that if there was a panic or a crisis, the whole thing wouldn't collapse on itself. And that's really why the Fed was set up, was to prevent financial crises. And they were given extensive powers of lending of last resort. So then we had this depression, and they didn't use any of those powers, and they got kind of a bad rap. And then after World War II, we started passing legislation to encourage the Fed to look at both inflation and full employment. So those are the kind of the next 2 topics we get to. But some central banks don't even worry about inflation. They target their currency. That would be the People's Republic Bank of China. Other central banks are more focused, or smaller ones, on piling up foreign reserves. And some of them even focus on like interest rate differentials. If you go to the Bank of Canada, they're very, very focused on how their interest rates compare to ours. And they're looking at the currency and inflation, but it's a more complicated message. So we want to kind of line up the tools with the objectives. And the tool that I'm going to focus on is short-term rates, because that's the one they basically use. I think we know where they all are, but the Federal Reserve is inflation and employment. The Bundesbank was only inflation. The ECB is supposed to be only inflation, but they got a financial system disaster on their hands. So that's what they're focused on. I'm going to talk a little about Brazil and China first. And the reason I want to do that is Brazil has followed a very interesting monetary policy. China's followed a currency policy, and that kind of leads us into understanding what's happening in the Europe and in the U.S. Let me go to Brazil. When I talk about a country, the first thing I talk about is their demographics. The young people are on the bottom of this chart. The workers are in the middle. The retired people are at the top. Half the population's under 30. If you have a demographic situation like this, you have only one thing in mind as a political leader. If I don't create jobs for all these people coming into the workforce, I'm out of my job. So it's all about jobs. So you can have a little more inflation. A lot of things are flexible, but not jobs. So Brazil, they've been growing their economy. This is their GDP per capita. They're building a middle class. They're having a lot of success. They're coming up, this is, again, GDP per capita compared to other countries. You can see they're moving up. They're ahead of China, not quite caught up with Mexico, but making a lot of progress. Now, over the last decade, The middle one there is their stock market compared to the U.S. stock market. If you put money in Brazil in 2000, you'd have made 350%, and if you'd put it in the S&P, thanks to 2008, you'd have made 14. But they've also a 4-to-1 ratio on inflation and a 3-to-1 ratio on real GDP.
Dollars or real?
This is actually, the real GDPs are converted by the World Bank into a purchasing power dollar comparison to try to make it apples to apples. Stock returns is dollars, and the currency's been taken out. Yeah, so you effectively hedged your currency and you still made that. You made that, although, because the real has, in fact, appreciated a little bit over the period. So you made some money on the stock market and the currency. And past performance is not a guide to future performance. I just want to really focus on their monetary policy for a quick second. The dotted line is the inflation rate, and the solid line is their short-term interest rate. They call it the SELIC, but it's their equivalent of Fed funds. This is a graph that would get you a PhD dissertation at the University of Chicago. They have maintained a very steady premium of interest rates over inflation. And it's about as steady as any central bank in the world. Now, if we ran this chart, it starts at 2006. If we ran it back into the 70s and 80s, it's a total disaster. Brazil had hyperinflation. It was always a basket case. It had tons of problems. And then they just decided, we're going to do this right. And they adopted this philosophy. Now, right now, their economy has really slowed down. It's almost not growing as the global recession kind of hits them hard. And their inflation rate is falling quite rapidly, and they've started to lower rates. But they really have adopted a very consistent monetary policy. The flip side of that, that's the economy slowing down. The dark line is their car sales, and it's not a good thing, but that's one of their leading industries. The flip side of maintaining a fairly stable monetary policy is that your currency gets hit with a fair amount of volatility. You kind of take the volatility out of the interest rates, you get it in the currency. This is a chart of the real, and if the line's going down, the real's getting stronger. You can see that in 2008, when we had our financial panic, that was a risk-off trade. So people took the Brazilian real off. Then they put it back on, and more recently, it started to weaken again as their interest rates have come down. But the point here is that for running the Brazilian central bank, their focus has been on reestablishing credibility by providing a premium of interest rate over the inflation rate, but they've had to accept a little more currency volatility, and on average, they've had a little stronger currency. And that has impacted them. If you talk to them, the leaders there, they would say negatively. But now, it's really a tale of two countries. I've messed with the axis on this one to put the Chinese currency and the Brazilian currency on the same chart. But Brazil was so focused on regaining credibility, it ran one type of monetary policy. The Chinese, they didn't want that currency to move. So they went for a stable currency. In 2005, they started to allow it to appreciate. And then they stopped right after the financial crisis and then let it kind of appreciate a little more. So it's a very different approach to running their policy. I'm going to skip over most of the China information here to get to the Europe and the US, the interesting things. But there are a couple of things I'd like to leave you on China. I want to make the case that they're going to allow their currency to become more normal, more convertible, more part of the world economic system faster rather than slower. And one of the main ideas about that is if you're back in 2005, if you had let the RMB float, there's no question it would have gone up. We don't know exactly how much, but it's appreciated about 30% since 2005. If you freed it today, I wouldn't know where to tell you to bet. My own view is it might actually go down a little bit, but with lots of volatility, so it wouldn't be a good trade anyway. What that means for their country is it's way easier to normalize a currency when it's not going to move really fast. So right now, they have an opportunity or a window to move faster in normalizing themselves with the rest of the world. And I'm expecting to see that. But here's why they're going to want to do it. China has a huge rural to urban migration going on right now. And this is the number of people, millions of people that leave the farm and come to the city every year, and it's about 15 million people now, which means they're building a new Chicago every year. So as long as this is happening, and it's going to happen for about another 5, 6 years, they really have to focus on jobs right now. That's their stable currency policy. But this is the future. This is a chart of the average age of countries, starting in the 1990s to 2025, 2021. The U.S. is getting older progressively, and we'll be over 40 sometime in the 2020s. China will catch up with us. So China is aging faster than any major country has aged. Now, neither one of us, China or the U.S., is as old as Japan. That's the top one. And we're a lot older than India, which is on the bottom for comparison. But as your country ages, your politics change. And they change to what I will call health and wealth. You're old, you've made your money, you don't want to lose it. So you want a stable currency, you want no inflation, lower taxes, everything that you can do to keep the wealth you've made. And the other thing is, your health isn't what it used to be, so you want a great health care system. So China is going to rapidly go from a focus on jobs due to the rural to urban migration, and in the next decade it's going to go to a focus on age. And that's going to totally change their politics. And they need to get that country ready for that. And part of that is opening it up to the rest of the world. That will be RMB normalization. And I just think it's going to happen a lot faster than people think. Now that China is about to go through a leadership transition, a younger group of leaders, they're ready to roll. We'll see if that works. Let's flip over. Oh, this is the other thing that China has to deal with is slower growth. This is I do my China forecast decade by decade, so in 10 years we'll come back and see how I did. They've grown at about 10% annually over the last 30 years, and we're seeing that it's going to slow to about 6.5% for this decade, and then it's going to be even a little slower the next decade. Now 6.5 is not bad. Nobody's, will take it. But you do have to understand that 15 million people that comes from the rural to the urban, that's worth about 3 to 3.5% of GNP. So if they actually got down to 4%, that'd be like a recession for them. And we do see them slowing down faster than the market probably thought they would. And we see them slowing a little more. Let's go to Europe. Europe is old. This is Germany's chart. There are more people retiring than there are young people coming into the workforce. The labor force is shrinking. If your labor force is shrinking, you're not going to grow as fast as you used to. Okay? Europe is not going to grow out of its debt problem. Not going to happen. But this is the German view of Europe. I want to retain my wealth. I want low inflation. I want a stable currency. I want a great health care system. And I'm really not concerned about the things Spain is concerned about. This is the Spanish view. These are unemployment rates of different countries. Spain has over almost 25% unemployment. Greece is over 20%. The euro area in general averages about 10%. So cyclically, if you're worried about unemployment, that's a whole different view of let's get growing again. France had their election back in April. They elected a president who wants to grow a little faster. Greece has their second election this weekend, and we're definitely going to see a lot of pro-growth attitude.
Historically, has Spain and Greece been that far out, or is this right now?
It's right now, but Spain has historically been the longest bar on the chart. If I had drawn that chart, say 4 or 5 years ago, Spain would have been like 15 or 14%, and the others would have been 8 or 9. Greece is a relatively new member to it being in the 20% category, because in Greece, 60% of the economy worked for the government, and that's being cut back. Hairdressers are part of the government there. Okay? I'm not kidding. So you're probably understanding a little more why the Germans don't want to pay for the Greeks. But this is just a different perspective on what's going on there. Now, I was at a conference recently and was talking to a foreign exchange specialist, and he was telling me, he says, Blue, if you really want to understand Europe, you got to read what was happening right after World War I. So I said, okay. And he said, you should read this book by John Maynard Keynes. Now, you probably know about Keynes as Keynesian theory or the general theory or whatever. This is from a different book he wrote in 1919 called The Consequences of the Peace. And it's right after World War I ended, and he's explaining why the peace treaty and everything is going to be a total disaster. But basically, what he's saying is that we don't look at things, we kind of forget the long-run stream of history, and because it's moving too slow, and then it catches up with us. And so we end up building a not very good plan, a not very good foundation. And if you think about the euro, you know, the euro was born with a birth defect. It didn't have any fiscal policy constraints in it that were meaningful. And yet it was going to put the monetary policy all in one place. And so you had this birth defect that we kind of all ignored. And then it just like caught up with us, wham, but it's been there all the time. Now the politics of the euro is that the European Financial Stability Fund and the ECB together have already given Greece about 300 billion euros, and they've promised another 100 or two. Now, and when I say the ECB, I'm counting the money that they've lent to the Greek central bank to support the banking system. I'm counting all the money that if the Greeks dropped out of the euro, that the ECB and the European Financial Stability Fund, they would be paid back in drachma. And I don't think we have to worry, but the drachma would not be worth what a euro is worth. Now, if they were to go out and immediately become, remonetize Greece and make it a drachma country again, they would probably do it starting at a 1-to-1 exchange rate with the euro, but I don't think that would last more than as soon as you could get to your terminal and short that thing. So the ECB and the European Financial Stability Fund stand to lose probably not the whole 300 billion euros, maybe only 225 billion of it. 300 billion euros is 3% of European Union GDP. On a good year, the European Union only grows about 1.5%. So they've basically given Greece 2 years' income already. Now, there have been 9 national elections since the financial crisis in Europe. All 9 of them have thrown out anybody on whose watch the problem occurred. So if you're a politician in Europe, or you're a technocrat, and you're on the verge of explaining to everybody that you've just lost 3% of GDP, you're going to do everything you can not to lose that. So if Greece wants to stay in the euro, my personal view is that the Germans and everybody else will cut them some slack. Now, if you're going into a poker game or you're going into a negotiation, you don't open with your compromise position. So the rhetoric that you're going to hear is going to still be aggressive. The Germans are going to say, no, you have to abide by it. But if there's any government in Greece willing to negotiate, I believe the Germans, the ECB, and all these groups will figure out a way to give them 3 or 4 more years and, as we say, kick the can down the road. It won't solve the problem, but it'll make it go away. But there's a small problem. There's some chance that the Greeks might not elect a government. In fact, it's about a 1 in 5 chance that they might not have a coalition that can form to do the negotiating. So even though, if you owe the bank $1 billion, you own the bank, they basically own the bank because they owe them so much. But if they don't have somebody to do the negotiating, they might get kicked out anyway. So the ECB, in my view, has 2 contingency plans. Contingency plan number 1, the Greeks can't form a government, they got to go, kick them out, and another €1 trillion go for the ECB across all the European banking systems to make sure the Greeks are the only ones that leave. The other possibility is that they negotiate a deal with Greece, they give them lots more time to pay, and then the ECB provides another $1 trillion funding facility to the European banking system so that the problem goes away for a while. So, as you can see, my view is the ECB is about to expand its balance sheet again, no matter what happens. It's just I don't know whether the Greeks are in or out. And we can figure all that out. You won't need me on around the 18th or 19th of this month, a couple of days after the election, to come up with some kind of view. This, by the way, is not good news for the euro as a currency, but there might be some kind of relief trade, although we saw how long that lasted on Monday morning. You can measure that in hours, but it did last a little bit. Yeah. So that's yes, that's right. So that's kind of the view of Europe, is that the debtors own the system. One of the things you've probably seen, CME volumes of FX futures, and particularly open interest, have gone up with the sovereign debt crisis in Europe, and that's because of the differences in counterparty risk. If you're doing your forward currencies with a European bank, you don't really know what the situation of that bank is. There's been a lot of movement out of the OTC foreign forward currency market and into futures, but particularly concentrated in the euro versus dollar contracts.
Why don't they clear the OTC here? Why don't they clear the OTC here?
They could, but you know, and some do, but the banks on the whole are not really driving this process at the moment. They would have to be part of that. The process has largely been driven by the end client, whether it's an endowment, a pension fund, a hedge fund, and they don't have time. They're just telling their trader, move that position into futures for now. One of the side effects of the way the ECB has handled this issue in Europe is that banks in Europe have become more national, less diversified, and have more national portfolios. That is, the ECB gave them this €1 trillion at 1% for 3 years to make sure they were liquid, but then what that bought them time, and what they did with the time is the French bank says, you know, I don't really like this Spanish and Italy debt. The Spanish bank said, I don't really like this French debt. And you ended up with most European banks shrinking their balance sheets, but becoming more focused on their own currency. So you lost some of the ability of diversification to limit the damage of the crisis. So if anything, the European banking system is it's a little smaller because it shrunk down a little bit, but each individual bank is a lot less diversified than it was 2 or 3 years ago. And some of the books that they're shrinking is that they tend to shrink their dollar books because that's less part of their core business. And when they have risky assets in dollars, they sometimes have a short hedge in U.S. Treasuries. So if you're trying to figure out how did 10-year Treasuries get to 1.5 or 1.6, part of it is the deleveraging in Europe of them shedding their dollar risky assets and then taking off their hedges. It's a small part of what's going on, but it's reinforced that lower yield trend. Let's go to the United States. Finish up here. We're old, but we're not as old as Europe. Our labor force is still growing, but not at as fast a rate as it used to. Whatever our long-term growth rate is, it's not as high as it was in the 50s, 60s, 70s, and 80s and 90s. We're also going to have some difficulty growing out of our fiscal problem, but we're not quite as old as Europe. Many of you are probably familiar with the Taylor rule. It's a mathematical equation that suggests a way of analyzing how the Fed balances the inflation and employment objectives that it has. If you go back to the original Professor Taylor's 1993 formulation, it will actually tell you, wow, this works, that the Fed funds should be 1.5% today. This little negative part, the Taylor rule said that the Fed should have taken rates negative. That's kind of hard to do, so that's quantitative easing. So based on this kind of formulation, the Fed appropriately expanded its balance sheet, but perhaps not appropriately hasn't started to get back to a more normal policy. I mean, we have unemployment is still way too high, but it has gone from 10 to 8. GMP is not growing as fast as we'd like it, but it has been growing for a couple of years. So there's a camp of people that would argue, and this rule would argue, that you should start the slow process of normalizing economic policy, monetary policy. And that would imply a 1.5% Fed funds rate, which, by the way, is not a tight policy. If inflation is 2%, you're still under inflation. It's a negative real return. So we're not talking about a tight policy. We're talking about moving toward a normal, accommodative policy. But the Fed is worried about things, as well they should be. The Fed tells us how the FOMC members would vote on when to raise rates. And I think next Thursday, they'll give us another read. So they asked the question of all the members of the FOMC, voting and non-voting, when do you think interest rates should go up? And you have 6 people that think it should happen this year, and those people are just posturing, and 3 people this year and 3 people next year. So you have 6 votes for sooner than 2014. And right now, the lightly shaded one is the votes that they took in April, and the blue ones are the ones they took in January. So in April, they came a little more centralized on 2014, and the people out there at 2016 said, no, it'll happen before that. So when we get the release of the press release after the next FOMC meeting, we'll also get this table. It doesn't come with the press release, it's a separate item, but you'll see it, and we'll see how these votes change. But they're not really votes, opinions. And the Fed, but Ben Bernanke looks at this chart and he says there's a central tendency on 2014. So he provides guidance to the market that says we're going to keep rates at 0 until 2014. I just want to make it absolutely clear. The Fed provides guidance. It does not make commitments. If the facts change, the Fed's going to change. So, we have to kind of figure out what they're worried about. This is their forecast on GMP, and this is actually how they evolve over time. In 2009, they thought 2012 was going to be a 4% year. In other words, they really thought we would be out of this problem by now and humming along. And then when 2011 came in at 1.7% GMP, they just marked down their forecast to 2.25%, 2.5%. So, their view is that we have like a 2.25%, 2.5% economy, which is probably about what we have. So it's a realistic view. But even with that view, they're still thinking they need to stay at 0 rates for a couple more years. And the reason that they feel that way, first reason we've already talked about, that's Europe. But the second reason is they are exceedingly worried about U.S. fiscal policy. The Bush tax cuts expire at the end of this year. The automatic spending cuts come into effect in FY 2013, which starts in October of this year. The debt ceiling will be reached somewhere around April, May, or June and breached again, and that's a messy debate. Not on this list, but you might have noticed the post office is out of money. The post office employs 600,000 people, and they could use like $10 or $12 billion. And of course, we can find the $10 or $12 billion, but the question is, from where does it come when you're trying to cut everything else? And we haven't even talked about the Medicare and Social Security problems. So we have a huge fiscal problem looming. So we're going to elect a new Congress. They're going to be sworn in on January 4th. And on January 5th, they're going to be faced with, what do I do with retroactive taxes? Do I have a long-term fiscal plan? And that's just looming over the economy as a huge negative. How do you plan your business? How do you make your forecasts? You don't even know what taxes you're going to pay. This is just not good. And so the Federal Reserve, recognizing that, is being exceedingly cautious about 2013. If we get some resolution on fiscal policy, the Fed will raise rates sooner. If it's a disaster, all bets are off. And by then, we'll know what's going on in Europe. Monetary policy after the Federal Reserve starts to raise rates, whenever that happens. So now forget about timing and think about when they do start to raise rates. It's now going to be a joint decision between how to deal with their balance sheet and how to deal with interest rate policy. There are two bars here. The solid black bar was the Federal Reserve's balance sheet at the end of 2011. And the gray bar, the light gray bar, was the Federal Reserve's balance sheet at the end of August, or actually September 8th, just before Lehman Brothers, 2008. So since the crisis, the Federal Reserve now owns 1.67 trillion of U.S. Treasury securities. They own almost $1 trillion of mortgage debt. So they've expanded their balance sheet to $3 trillion. And by the way, of that 1.6 trillion in Operation Twist, they've extended the maturities. So they are an exceedingly long duration portfolio. Now, you folks understand that if you own these things, you need to fund them. The Fed funds its positions by the interest rate it pays on what they call excess reserves. It currently pays 25 basis points. Now, the Fed does fund $1 trillion is in the currency in your wallet, of which they pay 0 on. So $1 trillion they borrow at 0, and the rest they borrow at the interest rate on excess reserves. Now, the average coupon on the 10-year is maybe 2. So once the federal funds rate gets above 2%, I don't care, 2014, 2015, whenever it happens, if they still own these things, they're going to be in a negative carry position for that part of the portfolio. Now, I don't know about you, but if you run portfolios, there's nothing wrong with taking a negative carry position, but it does focus your attention because you're losing money every day unless you get the prices right. And I might add that once the Fed goes back to normal and they start raising rates, I don't think we're going to be at a 1.6 or 2% yield on the 10-year. I don't know when the 10-year sells off, but again, economists have a rule, by the way, never forecast direction and timing in the same sentence. So we're following that rule. But at some point, higher Treasury yields suggest, and a higher Fed funds rate and a higher rate on excess reserves suggest they're going to want to sell these guys. But if you're the Fed and you think the economy's fragile, do you really want to dump $1 trillion of mortgages and Treasury securities on a fragile economy at the same time you're starting to raise rates? I merely raise these issues because in the past, the Fed really thought about inflation and employment, and now the Fed's going to think about inflation, employment, and its own balance sheet. And its own balance sheet is hugely complicated now. And I believe that it will slow down the process of raising rates. They'll raise rates a little slower, but they will at some point start to try to reduce this balance sheet. That should provide lots of action in the shape of the yield curve. So I don't know when this problem starts to resolve itself. So the timing question is dependent on Europe and mostly fiscal policy in the U.S. But when it does start, we're going to see a lot of volatility in the Treasury space. These are just the issues exiting quantitative easing. So that's kind of my view of where we're at. The economy's fine in one sense. We're growing at 2.5% or give or take. We're the unemployment rate's slowly coming down. So it's not growing as fast as we'd like, but we're out of the recession. The Fed has a huge problem on its hands about how does it get back to normal in any reasonable time frame. So that's where we are. Any questions, discussions? Did I make you think about something? Yeah.
Given the picture you were talking about Europe, with Spain now, all the issues going on in Europe, if Europe were to go down between now and the year end, does that mean that the Fed has to start doing things sooner? Because, I mean, that's a giant, number out.
Well, let's define what we mean by Europe going down. The way that the Fed would define that is a Lehman Brothers. That the banking system collapses on itself, the payment system fails to work, and we're just imploding. Okay, that's not Greek leaving the euro. That's the banking system going down. The ECB is hugely committed to making sure that doesn't happen. So we're depending on the ECB there. If for some reason the ECB treats their current problem like the Treasury and the Fed treated Lehman Brothers, then the Fed will have to provide more quantitative easing to make sure our banks are fine. And they will do so. They have the money, they have the resources, they have the commitment, and they're not afraid to expand that balance sheet. But it would not be a good thing for the global economy. I think the odds on that are exceedingly low because we've had so many lessons about how that works that I can't see the ECB messing it up. But, you know, can't see a lot of things. So the Fed would act, if Europe implodes, the Fed does more quantitative easing. And by the way, we'll know way before the end of the year. These things have a habit of picking up speed. So I'm looking for an exciting week next week. We're just waiting on the election before we, see how it's going to go. If they don't solve this thing in a meaningful way, the shorts are going to come out big time.
So you don't see, Germany pulling out of the euro just collapsing?
No. Well, the more money the ECB has to put in the European banking system, and the worse the situation is, that's not a good thing for the euro as a currency long run. The only thing that saves the euro versus the dollar is we're as equally screwed up in our own different way. Our fiscal policy issues and the Fed staying at zero even after the economy is growing. So basically, when you're trying to figure out whether the euro or the dollar is going to be stronger, you're looking at two currencies that are very weak. And now you're trying to figure out which one's weaker than the other. But if there's a problem with Greece and that doesn't resolve quickly, then the euro will more than likely, that's a good hypothesis that they might be the weaker one. But you might want to look further than the US for your long position. Yes?
Is the Fed able to quantify the U.S. banking risk in Europe?
The Fed can quantify it enough to make a reasonable policy judgment. And by that I mean they know it's huge. Can they quantify it even down to rounding to the nearest 10 billion? I don't think so. And the problem is they can quantify the bank loans. They know how much exposure a particular bank has to a European bank. But what they don't know is the indirect exposures to the large companies that may have been borrowing all over the place. So, okay, I know how much we owe BNP or they owe us or something, but I don't really know how much we're involved with Siemens and Alstom and all these other companies. So the indirect implosion in economics can often be larger than the direct. So they can quantify the direct very well, and the indirect is very slippery. Or unfortunately, or whatever, the problem is so big that we're all going to get the email on the same morning when we look at the news, and it's going to be such a big problem that they're going to throw $1 trillion more at it, and that'll be roughly what they need. So I mean, the rounding errors are just so large. So but that's kind of how they know it. They know the banking system, but they don't know the indirect stuff.
Can the ECB print money?
Can the ECB print money? The ECB, under its legal charter, can lend money to the European banks in the system. And it can lend money to the central banks of the countries. So it can lend money to the Bank of France, the Greek National Bank, the Spanish, so forth. So the ECB can expand its balance sheet through lending. The ECB cannot buy government debt like the Fed did. The Fed bought our debt, The ECB has bought some debt, but it's actually not part of its charter to do that. They've been able to kind of go around the edges, but it's not what they're supposed to do. So if the ECB will go into lending to the banking system, and in that sense it can print money. And it can print euros. So it could just print them up and drop them from helicopters, as Milton Friedman might have argued it should do. They won't do that, but but they are not supposed to bail out governments. They're supposed to bail out the banks. Yes?
What's your forecast on the U.S. housing market, and does that have any impact on Fed policy as well?
Question is forecast on housing in the U.S. and Fed policy. I'm on record from, I forget, a couple of 3 or 4 months ago as thinking housing's going to have its first decent year. Decent meaning we're going to grow off a really low base. But it does mean that I think housing prices will be higher at the end of the year than they are today. Housing starts will be higher at the end of the year than they are today, and home sales will be higher. So the housing market starts to come back, but from really low levels. Not enough additional construction jobs to make much of a dent. Does the Fed care about this? Yes, it does. Should it? I probably don't think so. But one of the big institutions that's in the fiscal policy mess is Fannie Mae and Freddie Mac. And you might have noticed the Fed owns $1 trillion of mortgages, and in that trillion there's actually about $100 billion of Fannie and Freddie securities. So the Fed is intimately involved in worrying about the American dream, owning a house. It's a political hot potato, and it's election year, and so yes, they are watching housing very carefully, and you could argue as an economist probably too carefully. But it does matter to them. But you can't solve the fiscal policy stuff if you can't solve Freddie and Fannie. And so it's all interconnected. So it's definitely in their brain and they're worried about it. But I do see them having a little better year. Housing it's off the bottom. You can go buy a house. It's okay. All right. This was fun. Thank you very much for some great questions. And oh, one more.
This is a completely different kind of thing, but in your job, do you consult on these various issues that they invent here? Like we have these housing futures and stuff like that. Do you actually get involved in that kind of stuff, or is it more at a policy level?
I'm in the research and product development area. That's where they put me, but that's where, because they couldn't figure out where to put me. So I'm technically in that area that would worry about the products, but I'm the only person on that team that doesn't, worry about the details of new products or old products. My job is to think about global issues, think about how they affect energy markets, agricultural markets, interest rates, equities, FX, everything we trade. Take a broad portfolio view, if you will, of what's happening there, but I stop before I get to the product area. So that's why I can get away with some of this stuff. I can talk about foreign exchange and interest rates and treasuries, but I'll never tell you this futures contract versus some other one. That's not in my mandate. I just get to think about world issues and see if I can get you thinking about them. Thank you very much.
Lou's also writing the cover story for our next Inside Advantage, and he's going to be focused on the energy markets. So look for that in July. And if you've got any feedback on this presentation or any future presentations, any other subjects that you'd like to see, definitely send us an email. We'd love your feedback. So thanks again.
Yes, thank you. I really appreciate this opportunity. So you've seen the overview, now we can do the specifics.
Yeah.